Picture two families living on the same street. Similar houses, similar cars in the driveway. Both have two kids, both have two working parents, and both bring in roughly the same combined household income, somewhere around 80 to 90,000 a year. The first family, let's call them the Martins, have always done what they were told. They opened a savings account at the same bank where they have their checking. Every month, whatever's left over after bills and groceries gets swept into that savings account. They feel good about it. They check the balance once in a while, see the number go up a little, and think they're making progress. The second family, the Gwynns, earn the same money. Same neighborhood. Same school for the kids. But about 3 years ago, they made a small shift. They moved the bulk of their savings into a different kind of account, one that paid several times more in annual interest. And they set up automatic transfers so they never had to think about it. They didn't invest aggressively. They didn't take risks. They just changed where their money sat. Fast forward 3 years, and the gap between these two families is startling. On the same income, with the same responsibilities, one family's savings cushion has grown noticeably, while the other's has barely kept pace with the rising cost of groceries. On the outside, nothing looks different. On the inside, one household has options. The other has a balance that feels like it should be bigger than it is. And here's the part that's easy to miss. The Martins aren't doing anything wrong by conventional standards. They're saving. They're not racking up credit card debt. They're being responsible. But their savings account, the default one that came bundled with their checking, is doing exactly what the bank designed it to do, not what the Martins needed to do. And that distinction, that quiet gap between what your bank wants from your money and what your family needs from your money, is what this entire conversation is about. Let me explain how this works, because it's one of those things that hides in plain sight. When you deposit money into a savings account, the bank doesn't just hold it in a vault with your name on it. That's what most of us picture, but it's not reality. The bank takes your deposits and lends them out to other customers buying homes, financing cars, starting businesses, carrying credit card balances. The interest rate the bank charges on those loans is substantially higher than the interest rate it pays you for the privilege of using your money. This gap is called the net interest margin, and for banks in the United States, it has historically averaged somewhere around 3% or more. So, if your savings account is paying you 0.5% or maybe 0.6%, and the bank is lending your money out at 6, 7, even 8% for mortgages and auto loans, the bank is keeping the vast majority of the return that your money generates. You get a sliver. They get the loaf. Now, I want to be clear about something. Banks are not doing anything illegal here. This is the fundamental business model of banking, and it has been for centuries. They take in deposits, they lend them out, they profit on the spread. It's how the financial system functions. But the part that matters to you and me, especially when you're supporting a family and every dollar has a job, is that most people never stop to ask whether the default arrangement is the best arrangement for their household. We just accept it. We opened the account, the bank handed us a debit card and a routing number, and we moved on with our lives. And that acceptance, that quiet settling into whatever the bank offered first, is worth understanding more deeply. Behavioral economists have a term for this. They call it status quo bias, or sometimes just inertia. It's the tendency to stick with whatever option was presented to you as the default, even when better options exist and are relatively easy to access. This isn't about being unintelligent. It's about how human decision making actually works under the weight of everyday life. When you're getting the kids ready for school, dealing with a stressful commute, managing deadlines at work, thinking about what's for dinner, and hoping the check engine light in the car doesn't mean something expensive, the last thing your brain wants to do is research savings account interest rates. So you don't, and the bank knows you won't. This is not a conspiracy, it's a design. Banks understand human behavior arguably better than most industries. They know that once a customer opens an account, the odds of that customer actively shopping around for better rates are very low. Research in behavioral finance consistently shows that people tend to stay with their initial financial provider for years, sometimes decades, regardless of whether better options become available. It's the same reason many people stick with the same phone plan long after cheaper alternatives appear on the market. Switching feels like effort. And effort, when you're already stretched thin, feels like a cost. But here's where it gets interesting and honestly a little uncomfortable. The average interest rate on a traditional savings account at a major bank sits around 0.5% to maybe 0.6% annually. Meanwhile, inflation, the rate at which prices rise over time, has been running well above that. Even in a relatively calm period, inflation tends to sit around 2 to 3%. So, if your savings account pays you 0.5% and inflation runs at 2.5%, your money is technically losing purchasing power every single year. That $5,000 you saved, a year from now, it buys less than it did today. The number in your account might go up by $25, but the cost of groceries, gas, school supplies, and everything else your household needs went up by more than that. You're on a treadmill, and it's tilted slightly downhill. Surveys frequently report that a significant portion of American households couldn't cover a $1,000 emergency expense using their savings alone. And what's haunting about that statistic is that many of those households do save. They put money aside. They try. But the account their money sits in pays so little that their savings never build real momentum. It's like filling a bathtub with the drain slightly open. You're adding water, but the level barely rises. And the bank is thriving. Major banks report billions in net interest income every quarter. That's the money they make from the spread between what they pay depositors and what they earn from lending. On top of that, many traditional accounts come with monthly maintenance fees, minimum balance requirements, and overdraft charges that can further erode whatever small gains your savings generate. Collectively, American consumers have paid billions in overdraft fees alone in recent years. It's a system where the institution profits from your deposits and then charges you fees for not having enough in them. When you step back and look at it from that angle, the phrase, your savings account is doing what the bank wants, starts to feel less like a provocative headline and more like a description of routine. So, what does this mean for a regular working household? It means the first step isn't to panic, and it's definitely not to pull your money out and stuff it under a mattress. It means becoming aware that the default option, the savings account that came with your checking, was never designed to be your best option. It was designed to be the most convenient option for the bank. Your awareness of that fact is worth more than any single financial tip. Because once you see the structure, you can start making decisions within it instead of just drifting along. Let me talk about what better actually looks like, because this isn't about chasing exotic investments or putting your emergency fund into the stock market. For most families, the most immediate and impactful move is simply understanding that high-yield savings accounts exist and are widely available. These are typically offered by online banks or online divisions of traditional banks. And as of now, many of them offer annual percentage yields in the range of 3.5 to 4% or even higher. That's compared to the 0.5% or less at your traditional brick-and-mortar bank. Same FDIC insurance. Same federal protection on your deposits up to $250,000. The only real difference is that many of these accounts are managed online without a physical branch. For most people in most situations, that's not a meaningful downside, especially since you can still link them to your existing checking account and transfer money back and forth. The difference in yield might sound small in percentage terms, but when you run the math over years, it adds up in ways that matter for a family. If you have $10,000 sitting in a traditional savings account at 0.5%, you'll earn roughly $50 in a year. That same $10,000 in a high-yield account at 4% earns $400. Over 5 years, that gap widens considerably, especially with compound interest working in your favor. We are not talking about getting rich. We are talking about your money actually doing something instead of slowly deflating while the bank makes a healthy return lending it out. Now, there's a psychological layer to all of this that I think is worth naming, because it explains why even smart, responsible people stay stuck in low-yield accounts for years. The first piece is what researchers call loss aversion. We tend to feel the pain of a potential loss more intensely than the pleasure of an equivalent gain. So, the idea of moving your money, even to a clearly better account, triggers a quiet anxiety. What if something goes wrong? What if I can't access it when I need it? What if the rate drops? These aren't irrational fears, but they're often disproportionate to the actual risk, and they keep people anchored to the familiar. The second piece is something behavioral economists describe as present bias. We overweight what feels comfortable right now and underweight what would benefit us in the future. Keeping your money in the same account requires zero effort today. Moving it requires a few minutes of research, filling out an application, linking accounts, and transferring funds. That's maybe 30 minutes of your life. But present bias makes those 30 minutes feel heavier than they are, especially when the reward, a few extra percentage points, feels abstract and distant. The bank benefits enormously from both of these tendencies. Your inertia is, in a very real sense, part of their business model. Richard Thaler, a Nobel Prize-winning economist, built much of his career studying exactly this kind of pattern. He and his colleague Shlomo Ben-Artzi developed a concept called Save More Tomorrow, which was based on the insight that people are far more willing to commit to saving more in the future than to save more right now. The principle underneath it is simple and powerful. If you design systems that work with human psychology instead of against it, people make better financial decisions without needing more willpower. That's the key insight for families. You don't need to become a different person. You don't need more discipline or more financial literacy than you already have. You need better defaults. You need to set things up once, correctly, and then let the system carry you forward. And that's exactly the approach I think makes the most sense for busy households. Forget motivation. Forget checking your accounts every day. The goal is automation and structure. Here's what that looks like in practice, and I'm going to break it into 3 time frames because I know how overwhelming it feels when someone hands you a list of financial changes while you're just trying to get through the week. This week, the move is simple. Look up what interest rate your current savings account is actually paying you. Not what you think it pays, not what it paid when you opened it, what it pays right now. You can find this in your online banking portal or by calling your bank. Most people who do this are surprised, and not in a good way. Once you have that number, spend 10 minutes searching for high-yield savings accounts. You're not committing to anything yet. You're just looking. You'll notice that many reputable online banks, ones backed by FDIC insurance, offer rates that are 5, 6, even 8 times higher than what you're currently earning. Just let that information sit with you. This month, the move is to open one of those accounts and set up an automatic transfer. It doesn't have to be a large amount. Even $50 or $100 per paycheck moved automatically starts building a habit and a balance in a place where your money is actually working closer to its potential. Keep your traditional checking account for daily spending. Keep a small buffer in the linked savings if that makes you feel secure. But let the bulk of your longer-term savings sit where it earns more. The act of setting up that automatic transfer is the most important financial decision most families will make this year, not because the amount is large, but because it removes the need for ongoing willpower. Once it's automated, it happens whether you're having a good week or a terrible one, whether you remember to check your finances or not. This year, the goal is to build on that foundation. As your high-yield savings grows, start to think about tiers. The first tier is your emergency fund. Most financial guidance suggests 3 to 6 months of essential household expenses. That money stays liquid, stays accessible, stays in the high-yield savings account. It's there for the car repair, the medical bill, the sudden job disruption. When you're supporting a family, this buffer isn't a luxury. It's the thing that keeps a bad month from becoming a bad year. The second tier, once your emergency fund is solid, is to begin exploring whether additional money should stay in savings or whether some portion might work harder in other vehicles. Things like certificates of deposit, treasury securities, or broad index funds for longer-term goals. I'm not going to tell you exactly what to buy or where to put it, because every family's situation is different and there's real risk involved in any investment. But I will say this, the conversation about what to do with money beyond your emergency fund only becomes possible once you've stopped losing ground to inflation in a low-yield default account. You have to fix the foundation before you think about the roof. One more thing worth mentioning, because it comes up a lot in households where both partners are working and life is just relentlessly busy. Tracking your spending doesn't have to mean obsessing over every coffee or feeling guilty about ordering takeout on a Friday night. What tends to happen is people hear budget and immediately picture a spreadsheet that sucks the joy out of life. That's not what I'm suggesting. What I am suggesting is awareness. Just knowing, roughly, where your money goes each month gives you the ability to spot patterns. Maybe you notice that subscriptions have quietly crept up to $200 or $300 a month. Maybe you see that one category, food delivery or impulse purchases after the kids go to bed, is larger than you realized. You don't have to eliminate these things. You just have to see them. Because once you see them, you can make a conscious choice instead of a default one. And making conscious choices instead of default ones is, in many ways, the entire theme of what we've been talking about. Let me circle back to where we started. The Martins, ending Wens. Same street, same income, same pressures. The Martins kept their savings in the account the bank gave them. They earned almost nothing on it. Over time, inflation quietly ate into their purchasing power. The bank, meanwhile, lent their money out at several times the rate it paid them, collected the spread, and reported healthy profits to shareholders. The Martins aren't failures. They did what most people do. They accepted the default. The Nguyen's didn't do anything radical. They didn't take big risks. They didn't discover some secret investment. They just asked one question that the Martins never thought to ask. Is this the best place for our money to sit? And when the answer was no, they spent half an hour one evening, after the kids were in bed probably, and moved their savings to an account that actually respected the value of their deposits. They automated the transfers so they'd never have to think about it again. And over time, that small structural change created a cushion that gave them something money can't directly buy, but absolutely enables options. The option to handle an emergency without panic. The option to say yes to an opportunity without going into debt. The option to feel on a quiet Sunday morning that the ground beneath your family is a little more solid than it was last year. Your savings account is doing what the bank wants. The question is whether you'll let it keep doing that, or whether you'll spend 30 minutes this week making it do what your family needs instead. It's not a dramatic change. It's not a risk. It's just a decision to stop accepting the default and start choosing on purpose. And for a working household, that might be the most valuable financial move you make all year.